If you made $100,000 and you went to an accountant and you asked them, what is the tax rate going to be on $100,000 worth of income? The first question that they're going to ask you is, how did you make this money? Because if you made this $100,000 from your job, you're going to have one tax rate. If you made this $100,000 from your stock market investments, it's going to have a completely different tax bill. And if you made this $100,000 from your real estate investments, it's going to have a different tax bill. If you go to work every single day and you get paid a paycheck as a W-2 employee, this is called ordinary, otherwise known as earned income. If you sold a stock and you made a $100,000 profit and you own the stock for longer than a year, this is called portfolio income and you pay long-term capital gains. If you made $100,000 in cash flow from your real estate investments, this is called passive income in the eyes of the IRS. Do you want to know which of these three different types of income has the highest tax rates, meaning the highest tax brackets, and the lowest deductions? This one right here, your ordinary income. The money you make from your job. The money you make from what you do comes with the highest tax rates and the lowest tax deductions. The money you make from what you own comes with lower tax rates, and it also comes with higher tax deductions. So the first thing that every wealthy person tries to do, which is something that anybody can do, is they work to recategorize their income. They don't just work for this ordinary income, they invest their money into assets. That way they can earn this type of income. Portfolio income is when you own an investment and you sell it for a profit. This is like your stock market investment income, assuming you own your investments for longer than a year. And your passive income is things like rental checks with real estate properties. This is a different type of investment income, and it comes with its own set of tax deductions. So wealthy people are working to move their income from here to here because this comes with bigger tax breaks, not to mention the fact that when you own an asset, it also requires less time than going to work every single day. So if we come back to this tax chart, what we just talked about is changing your tax rate, because now when you recategorize your income, you have the ability to pay a lower tax rate legally. So the question here is, how do you lower your taxable income? Because you're not taxed on your gross income, you're taxed on your taxable income. This is the gross income minus all of your deductions. This is what your taxable income is, and this is where it pays to have a good accountant on your side, because a good accountant's job is to help you find the most amount of deductions and write-offs possible. That way you have the lowest taxable income possible, because when you have the lowest taxable income, that means you're going to have a lower tax rate as well. Now, for the majority of people who work a job, if you were a W-2 employee, the way that it works for you is like this. You make money from your job, then you might get the standard deduction, which is what the IRS offers to everybody. And then after the standard deduction, you pay your taxes. And then this is the money that you have left over to go out and spend. This is the money that you can use to buy a car, to buy a home, to go out on vacation. This is the money that you have to do that, your post-tax income. But if you own a business, this could be a real estate investment business, this could be a business that you created, this could be a business that you bought. Now this is completely flipped. Now the way that it works is you make money from your business, then you pay your expenses right here, and then you pay taxes on whatever is left. Because now these expenses are deductions that you can take against your gross income, which is why you have a much slower tax liability, a lower taxable income, because you're paying for your expenses first. Now the question is, what can these expenses be? Well, these expenses have to be used inside of your business to help grow your business, but this again is where the help of an accountant is going to become so important. That way you can classify the right expenses, that way you can use as many expenses and deductions as possible. I own a business. I need a laptop to run my business, so my laptop was an expense that I get to deduct from my income before paying taxes. I need a phone from a business, so I deducted my iPhone from my income. I had to go to San Diego last year, I had to go to Manhattan last year. I spent about 2 months in San Diego and about a month and a half in Manhattan last year. Both of those were expenses. I got to expense my travel, my flight, my Airbnb, my meals. All these things were expenses that I got to deduct from my income before my taxable income. Now, if I didn't own a business and I wanted to go to Manhattan, well, now I have to spend that money with my post-tax income. I make money, I pay taxes, and then whatever's left I have to use to fly to Manhattan. If I wanted to go to San Diego, the same thing. If I wanted to buy a cell phone, same thing. If I wanted to buy a laptop, same thing. Here, if I needed to buy a truck for my business, if it classifies under the right exemptions, because there are deductions out there right now that will allow you to deduct the value of a heavy vehicle against your income. So if I went out and bought a $150,000 G-Wagon, I could deduct most of the value of the G-Wagon against my income. Now again, I have to justify that I'm using it in my business, but this is where now clever accounting comes into play. Like last year, my accountant kept telling me to buy a G-Wagon. Why a G-Wagon? Because he said that we could justify that if I bought a G-Wagon, he could say to the IRS, look, Jaspreet is an influencer. He needs to maintain his image as an influencer. How can he do that? Well, he can buy a G-Wagon, and now this G-Wagon is a tax deduction for him. Now, did I buy a G-Wagon? No, because for me, I don't want to go out and just spend my money to spend it, not to pay money in taxes. I'd rather pay a little bit of money in taxes and have more money at the end of the year rather than go out and buy something that I don't need. But this is where fancy accounting can come into play if you have a good accountant, because now you can use a tax code which is written by the IRS. And now you can use the code to your advantage, but you have to understand how it works. Now, I am not an expert in the tax code, but I have hired an expert in the tax code. I have hired an accountant whose sole job is to study the tax code, study the deductions, stay up to date on what's happening, and then tell me what I can do in terms of tax planning so I know how to spend my money and different ways for me to now use my money. That way I can pay less money in taxes legally. Remember this, it's not how much money you make that matters, it's how much money you keep. If a doctor, a stock market investor, and a business owner all made $1 million in a year, they're not all going to keep the same amount of money after taxes. The doctor might be paying 40 to 50% of that money in taxes because that's ordinary income and you have the least deductions. Now, the amount of money you're going to actually pay is going to depend on what state that you live in, what state taxes you have, but you might have to pay $400,000 to $500,000 that year in taxes, meaning you're left with $500,000 to $600,000 worth of your income. Still a lot of money, but nowhere near the $1 million that you earned. The stock market investor earned portfolio income, which means you get the benefit of a lower tax rate, which means the top tax rate for you is 20%, meaning you're going to be paying about $200,000 in taxes. You still made $1 million, but you get to keep $800,000 out of that million. And third, now you have the business owner who made $1 million. Now, if the business owner made $1 million but had no other deductions, that was their profit, that's their taxable income, they're going to pay the same tax rate as the doctor, that $400,000 to $500,000 in taxes. However, you have the ability now to harvest debt that the doctor couldn't do. And this means that you'll have the ability to keep money in your bank account and not have to pay taxes on all that money. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.